Well, hello. It's been a few weeks, so it's very nice to be back with you again. I'm Nicholas Bohnsack, the President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. Let's jump right in. Over the last several months, investors have increasingly been confronted by two distinctly different investment outcomes impacting their portfolios. In the short run, there is little on the macro landscape to dampen our optimism. The economy continues to strengthen from the worst of the pandemic as we clear the virus and continue to reopen. The combination of extraordinary fiscal and monetary stimulus continues to rev the engines for both corporate investment and retail consumption. We remain very bullish on the prospects in this environment for equities. As we highlighted in a recent U.S. equity sector allocation report for Baird Private Wealth Management, we continue to be biased towards the cyclical corners of the equity market, recommending above benchmark allocations to the industrials, financials, energy, and material sectors. Not surprisingly, the market is pressed to a series of fresh all-time highs in this environment. So if anything has weighed on investors in recent weeks, it's the growing uncertainty on the horizon, questioning the durability of the recovery as we look into next year and beyond. The prospect of significant fiscal drag, a mathematical certainty given current spending provisions, and the likelihood that taxes on income for high earners and investors will be notably higher next year are both contributing to the dampening of optimism. Of course, uncertainty makes investors nervous, so the demand-fed, stimulus-backed, liquidity-driven recovery we're enjoying today needs an organic driver of growth to help muscle through this impasse. Perhaps the adroit implementation of the administration's far-reaching infrastructure proposals could do the trick. Time will tell, but in their absence, the follow-through may be somewhat muted next year. We're watching three items that should give us a better sense of whether we will need to de-risk our portfolios, and if so, when. First, the general trend in economic and corporate data are critical. Consider these two charts of employment and earnings. In the first, U.S. non-farm private payrolls continued to improve from their lows last year, as these data from payroll service provider ADP highlight. Getting more folks back to work will intensify the recovery and ease the reliance on government transfer payments. And in the second chart, we can see the outlook for corporate profits continues to improve. Estimates for S&P 500 earnings over the next 12 months are approaching $200 per aggregate share and are well above levels seen before the onset of the pandemic. Both continue in the right direction, and taken together, it would appear too early to pull back from equities too much. We'd also keep a close eye on legislative developments from Washington. The irony should not be lost on anyone that both legislative gridlock and greater bipartisan cooperation may provide the market with exactly the calm the economy needs to allow nascent recovery forces to take root. So stay tuned. And lastly, in periods of transition, the markets themselves can be a signpost, and in this instance, we'd pay particular attention to the relative performance of global cyclicals and global rates. It's not inconsistent for stocks and rates to work higher and at the same time. In fact, there's quite a bit in the offing to suggest it could happen again now. So we'd stay bullish and we'd keep our heads down. But know that the Baird team will be with you every step of the way regardless. Stay well, and we'll see you again soon.